Today we are going to go over the different types of Canadian investment accounts. If you're new to investing, then today's video is going to shed some light on the different pros and cons of each type of different account type. So hopefully at the end of the video, you can make a more informed decision as to which investment account type is right for you. Hey everyone, my name is John and welcome back to another video about Canadian investing. So we're going to cover topics such as ETFs, high interest savings accounts. In today's video, the three types of Canadian investment accounts that are open to Canadian investors now. In order to buy securities such as stocks, bonds, and ETFs, you need to have a special investment account rather than your typical checking or savings account. So essentially, when you want to start investing, you're going to have to open an investment account with a broker, whether it's an in-person broker or if it's an online broker. Now, personally, as a millennial, I'm all about the online stockbrokers because they typically come with much lower fees, and sometimes for certain securities such as ETFs, there's no fees whatsoever. Personally, I would either go with Wealthsimple because of the really good customer service, an amazing platform, or I would go with Questrade because they have extremely low fees. But either way, whether you choose an online stock brokerage or an in-person stock brokerage, or sign up through your banking institution such as the TD Direct Investing account, they're pretty much going to offer these same account types, which either fall under the unregistered category or the registered category of investment accounts. Now, while there are a significant amount of differences between registered and unregistered accounts, the main difference here is really going to be the terms of tax sheltering, because registered accounts, as their names would suggest, registered and controlled by the Canadian Revenue Agency. So the tax sheltering characteristics of the registered accounts are really what make them so appealing to investors. And we're going to talk more in depth about this after we discuss the unregistered accounts. Now, when it comes to unregistered trading accounts, there are two main account types that you can open. First up, we have the cash account, and then we also have the margin account. Cash account is the most basic and bare bones investment account that you can open with no tax benefits at all. This means that all earnings from this account, whether dividend or capital gains and interest, count towards personal taxable income. You must pay taxes on this extra income coming for if you decide to sell your securities. So straight off the bat, I can guarantee that if you're looking to get into investing, it's certainly not to pay the tax man any more money. So I would not recommend starting out with a cash account. And to quickly go over the margin account, this account is pretty much the same as a cash account, but rather you can borrow funds from the broker and leverage more funds in a trade to hopefully reap higher rewards. However, borrowing funds to invest when you're a beginner is not what I would personally recommend, so be careful and consult a professional before investing any borrowed funds. Alright, now that we've gone over the unregistered accounts, we can now hop into the most advantageous account, which the registered accounts such as the TFSA, so the tax-free savings account, and then we also have the RRSP, which is the Registered Retirement Savings Program. Now, each account does come with tax sheltering benefits as I mentioned, but the tax sheltering benefits are going to come at a different moment in time depending on if you have the TFSA or if you have the RRSP account. Let's get into the specifics of each registered account, starting with the TFSA, the tax-free savings account, or TFSA for short. Is a relatively new registered account introduced in 2009 by the Canadian government. And the goal of this TFSA is to allow Canadians to invest pre-tax dollars into an investment account to a yearly maximum contribution limit, then be able to withdraw those contributions, including interest incurred over time, on a completely tax-free basis. So the trade-off here is that your contributions to a TFSA account are not eligible for a tax deduction in that given year. However, all the contributions and interest incurred over time are completely tax-free when you take them out, because you've already paid income tax on your contributions way back when you put them in. So for example, here, if you make $50,000 in 2019 and then you contribute $5,000 to your TFSA account, you're still going to have to pay income tax on your $50,000 of gross income, considering you don't have any other income sources. But then in 20 years, when that $5,000 contribution, let's say, grew into $20,000, when you go to withdraw that $20,000, so the $15,000 of interest plus that $5,000 of actual capital invested, you don't have to pay any income tax on that $20,000 in the year, let's say 2045. So at this point, we're talking about the TFSA, you might be wondering, hey, can I go buy, let's say $200,000 worth of Snapchat stocks and then have that grow over time and withdraw all that money tax-free. Although that really would be nice, I hate to break it to you, but the government of Canada has set contribution limits that you have to respect each calendar year. However, the good news here is the contribution limits are cumulative, meaning that every year that contribution limit is carried over if you haven't used it from the year that you turn 18 years of age. Meaning that if you turned 18 3 years ago, you would have 3 years of contribution room accumulated from 2009 to 2012. The yearly contribution limits was $5,000 a year. From 2013 to 2018, the annual limit was $5,500 a year. Except in 2011 where the limit was actually $10,000, and finally in 2019 we have a limit of $6,000, meaning that you turned 18 before the year 2009 and never had any contributions to TFSA. You would have a total cumulative contribution limit of $63,500. To really put that into perspective, if two people invested the entire $63,500 at a 7% interest over a 1-year period, then both withdrew those funds, one however being in the TFSA and one in a cash account, each person's investment will have grown by $4,400 and $45 at the end of the year. However, the person in TFSA could take the money and run, while the cash account version would have to include that into their taxable income, which would corrode these capital gains by up to $1,300. Alright, so with the TFSA covered, let's now move to the RRSP account. RRSP account is a registered retirement savings program which was introduced in 1957 by the Canadian government to incentivize people to start investing into their retirement. Now remember guys, the RRSP is a registered trading account, which means that it comes with some tax sheltering benefits. The main tax sheltering difference between the TFSA and the RRSP is that the contributions that you make to your RRSP account in a given calendar year are going to count towards a tax deduction for that contribution amount in that calendar year's tax return. Whereas with the TFSA, as we saw earlier, even if you contributed a $5,000 to your account in the year 2018, you still have to pay income tax on the $5,000 because the contributions made to your TFSA are pre-tax. So let's illustrate this with an example to make it a lot clearer for you. If your buddy Alex lives in Vancouver and earns $50,000 from one single source of income, and 2018, to make things quite simple, that means that at the end of the year, he owes the government roughly $11,000 in income tax, which represents roughly 30% of his entire income. If he contributes to his TFSA, he'll still be paying the same amount in income tax. However, if Alex contributes $5,000 to his RRSP taxable income, is reduced down to $45,000 and have to pay roughly $9,300 in income tax, in contrast to the TFSA when Alex withdraws funds from his RRSP later on in life with all the withdrawals will count towards the actual taxable income. The goal with the RRSP is you'll most likely be making more income in your 20s, 30s, and 40s than during retirement when you don't have any active income coming in. So this becomes more advantageous tax-wise. Now, just like the TFSA, there are contribution limits to the RRSP, but this is calculated much differently. Instead of having a predefined contribution limit that imposed by the government that everyone has to respect, your RRSP contribution limit represents 18% of your year's income. For example, if you made $50,000 in 2018, I'd be able to contribute about $9,000 to my RRSP account in this calendar year. And if you don't use your contribution limits, this is cumulative. It carries over to the next year for every year that you're over 18. So with that all said, after looking at the different account types, this is a good time to give this video a thumbs up. If you were to ask me which account type would be best to open first, I would definitely say that you have to go with the registered account because that's an absolute given so that you can take advantage of the tax sheltering benefits. If you've never contributed to both an RRSP or TFSA account and you've been 18 for quite some time now, it's safe to say that you have a pretty hefty contribution room which you should max out before ever considering using a cash or margin account when deciding between the RRSP or the TFSA. However, it's really going to depend on your goals as an investor and your time horizon for your investing. Personally, I would recommend starting off with the TFSA, especially for a younger investor, because my theory behind this is that while you're in your 20s, you're more likely going to be making less money than in your 30s, 40s, and 50s on average. So for that reason, you're in a lower tax bracket right now, so a contribution to your RRSP account isn't going to have as much of a significant impact on your tax deductions at the end of the year versus say in your 30s or 40s when you're in a higher tax bracket. That contribution deduction is going to make a higher impact. And on top of it, if you want to start contributing to your TFSA account early, you can maximize the compound interest through your time horizon in investing, and this is going to have a significant impact on your interest over the long term that you can withdraw later on in life. Once again, that's just my opinion. Alright guys, so thank you so much for watching today's video. I hope it gave you some valuable insight on which account is right for you. If you enjoyed it, please make sure to give it a thumbs up and subscribe to the channel. We talk about personal finance, investing, entrepreneurship, real estate, and about Teslas. And as always, I'll see you guys in the next one.